All right, let's dive into what might be the single most important part of investing. And here's a hint. It has nothing to do with complicated formulas or trying to predict the market. Nope, it's all about mastering your own behavior. This is going to be your study guide.
So to get us started, I've got a question for you that honestly sounds more like a riddle. It's the true story of a guy named Ronald Read. Now, he was a janitor, and when he passed away, he left behind an $8 million fortune. So the big question is, how on earth did he do it?
So when you look at how he did it, what's not there is just as telling as what is. You won't find a winning lottery ticket. You won't find some secret inheritance or a single genius stock pick. Ronald Read was a janitor and a gas station attendant his entire life. His secret? Well, it was shockingly simple. He just saved what he could, consistently, year after year, and let the incredible power of compounding do its thing over decades.
And his story just perfectly captures the main idea we're digging into today. You know, we have this common belief that to build wealth, you've got to be some kind of financial wizard, right? You need a fancy degree, you need to know all the jargon, but the reality, which Ronald Read's life proves, is that your behavior is your actual superpower. How you act with your money matters so much more than what you know.
Morgan Housel, who wrote the book that inspired this whole explainer, he puts it perfectly. Financial success, it's not a hard science, it's a soft skill. It's about how you behave, not just what you know. Okay, so with that as our foundation, let's jump into our first big lesson.
First up, we've got to talk about one of the scariest parts of investing for a lot of people, dealing with the market's wild ups and downs. This first lesson is all about what we'll call the price of volatility. And the key here is to completely reframe how you think about it. It's not a fine you pay because you did something wrong. Think of it as the fee you pay for a ticket to long-term growth.
Okay, think of it like this. Let's say you want a really nice new watch. You go to the store, you see the price, and you pay for it. You don't try to run out of the store with it, right? You get that it has a price. Well, investing is exactly the same. The price you pay for the opportunity to earn those amazing long-term returns is volatility. All those scary dips and swings in the market, you've got to be willing to pay that fee to get the reward. And trust me, that fee can feel steep. Just look at this timeline. If you had just put your money in a simple S&P 500 index fund back in 1980, the end result is, well, it's fantastic. Huge wealth creation. But getting there? Oh, that required paying a heavy price. To get that reward, you would have had to watch your investment get cut in half at one point. You'd have had to stomach a combined total of 13 years where your portfolio was down at least 20% from its peak. That is the price of admission. And staying the course, even when it feels terrifying, that's how you pay it.
All right, on to our second lesson. And this one tackles a really dangerous psychological trap that can derail even the wealthiest people out there. It's the endless, nagging pursuit of more. And it's all driven by comparing ourselves to others. And as you're about to see, this is a game you just can't win.
This ladder of comparison really illustrates the problem perfectly. I mean, think about it. A doctor making $500,000 a year, they are objectively rich, right? But then they go to a dinner party and meet a CEO who makes $10 million. And that CEO feels pretty good until they're on a private jet with an athlete who's worth $2 billion. And even that athlete might feel a little small next to a tech founder worth over $100 billion. See what's happening? At every single level, the goalposts for what rich means just keep moving further and further away.
The reality is, there's always a bigger fish. So the most important question is one you have to answer for yourself. When is it enough? Because if you don't answer that, the danger is you'll start taking really foolish risks. You'll risk everything you have and need, all for a shot at something you don't have and don't actually need. You have to be the one to define your own enough.
Okay, our third and final lesson for today is all about mindset. When it comes to money, have you ever noticed how pessimism often sounds incredibly intelligent? It sounds so persuasive. But as we're about to see, it's actually long-term optimism that builds real, lasting wealth.
So here's why we're so drawn to pessimism. Our brains, they're literally hardwired for survival. We treat threats as way more urgent than opportunities. So a story about a sudden market crash, that grabs our attention immediately because it's a threat. But progress? That tends to happen slowly, steadily over time. It's a much less dramatic story. But over the long haul, that slow, steady progress is what creates all the growth and opportunity. You have to make a conscious choice to focus on that long-term optimistic view.
So, we've covered the lessons. Now it's time for the final exam. And this exam is all about taking these ideas and turning them into a personal plan of action.
Look, the absolute best way to survive those inevitable market downturns is to prepare for them before they happen. This means building yourself a financial safety net so you're never ever forced to sell your investments at the worst possible time. And you can start small. A shocking number of people can't even cover a simple $400 emergency, so make that your first goal. Automate your savings so it just happens without you thinking about it, and then build from there until you've got a solid 3 to 6 months of expenses tucked away.
Now, to escape that trap of more we talked about, you have to define your own finish line. This is where you decide what enough really means to you. It's about setting goals based on your own life, your own values, not what you see somebody else doing on social media. And the most important rule of this entire game is this: never, ever risk what you have and need for something you don't have and don't need. Once you hit your goal, give yourself permission to stop moving the goalposts. You can actually enjoy what you've built.
And that brings us to our final question for you. The entire point of all this is that finance is deeply personal. It's way more about psychology than it is about science. So take these lessons and really sit with this question. What does a successful financial life actually look like for you, on your own terms? Because that's the only definition that truly matters.